Bulls, bears, and ducks? Ugly ducklings? Oh my, with the market still near record highs, pulling back today at this hour, traditional yield sectors are getting expensive. That means companies that pay out dividends. Dow is now down 80 points in these final 3 minutes of trade. My next guest says, go for the ugly ducklings. Those should be on your radar. With me now, Alpine Funds portfolio manager Mark Spellman, who's turned many ugly ducklings into beautiful swans. $2 billion plus in assets under management. How do you spot an ugly duckling?
Well, first of all, you go to the balance sheet and the cash flow statement.
Okay.
And companies that have a great franchise are something you're looking for a good opportunity to buy them. If they're generating lots of free cash flow, continue, and maybe they've had a little bit of a hiccup recently or some macro issue, that cash flow is going to keep you involved, and that's the opportunity. When you see a company raising its dividend 10 plus years is what's something we look for in our rising dividend.
How is that an ugly duckling, though? I would think, and tell me if I'm wrong, I would think as you're looking for ugly ducklings, they might be unloved names. Yeah,
well, for instance, we recently got involved with a supermarket chain, Kroger.
Right.
Stock's down 25% year to date in an up market. That's kind of an ugly duckling as far as we're concerned. That's a stock, again, that matches
your metric there.
Yeah, our metric for rising dividend. 10 plus years, 14 times earnings, generating cash, buying back stock. They're giving Whole Foods a run for their money. Part of Whole Foods' problem has been Kroger's been so impactful on organics. They've been triple their private label. Right now they're having this deflation food issue, which I think is going to dissipate soon. And I think if you have a 12 to 18 month time horizon, you're going to do real well.
Maybe they capitalize on
down 25% qualifies as an ugly duckling.
Sure, well, that is, but then why Discover Financial? Because I was looking at that one year to date, it's actually up 8%, so it's matching or beating the S&P. Over 26 weeks, it's up 30%, and it doesn't look ugly to me.
Yeah, recently it's up in the last 2 months since the last quarter. And if you go back about a year, it's definitely underperformed. Financials in general have underperformed. Discover has been, everyone's been waiting for higher rates. They've been thinking that's going to benefit them. Again, that's a name that just raised its dividend, is buying back lots of stock. We think they're making inroads with millennials. They have some great features, the FICO score, the Freeze It feature. That's a stock sells at less than 10 times earnings.
Do you get worried when you see a day like this after markets hit record after record? We're down 81 points for the Dow Jones Industrials right now.
Mm-hmm. I don't get worried. I'm worried about the complacency, frankly. There's been over 30 days of less than 1% move in the market. That's very, very low volatility.
Right, tight range.
I happen to agree that we are not discounting the potential for higher rates. And if that were to happen, that's going to be a problem. And exactly those names like the consumer staples and utilities, they're not discounting that.
Okay. Mark Spellman, thank you very much.